joining us on the show right now. Hi Vikas, a very good morning and good to be speaking with you. And Vikas, at the start, we won't ask about your take on the Indian markets because you have been very bullish. You continue to believe the long-term India growth story. But from last time to now, Vikas, a lot has changed. 50% tariff has been slapped on India. But on the other hand, a bigger push with respect to GST is what is likely for the markets and the economy as well. What are you making of the consumption basket right now, and anything in particular that you are looking closely at?
I think it's significant rationalization and the reduction in the GST in indirect tax always helps consumer that the effect affordability gets better, and I'm sure it will have a positive impact, because it leaves too much to that extent the disposable income in the hands of the consumer. So it's quite positive, and generally it should be more positive for consumer discretionary, but in general it's going to be positive. And fact that we are having dual benefit of interest rates coming down as well as tax coming down, so both should only contribute positive in terms of consumption growth. So, and we've been quite positive about, as you rightly said, on the markets. There's a lot of negativity, pessimism around in the market, and despite that, markets are holding on. That clearly shows that there's quite a bit of resilience, and the current ongoing tariff situation may not last for very long. And once that settles down, I'm sure we will see reasonably good run in the markets.
Okay, Vikas, so that's your take on the strategy going ahead. But Vikas, very interestingly, we were just going through your letter to investors for the month gone by, and something that really stands out is the takeaways that you have mentioned when you say price doesn't always mean value and scarcity doesn't always mean quality. Have you kept in mind any particular sectors or stocks while mentioning this? And just if you could elaborate on this.
I think this letter we clearly, wrote about, as you would see that in time again, market operates in collective psychology. The fads get built, right? And that fad lead to FOMO, and then kind of tends to create, the not so qualified or, equipped investors to participate in those fads. And they only tend to look at price, and they look at, more the scarcity. They tend to buy because of psychological behavior due to FOMO. They tend to buy more. So here we're trying to highlight the time and again markets go through these cycles, and one has to stay away. In 2021, new tech stocks were going through similar kind of phase, and most of the investors, especially retail and so not so qualified investors, fell prey to that and lost a lot of money over the last 5 years also, or 4 years also. They have not really made any money. In fact, lost a lot of money from the prices they bought. So same thing is happening these days in the private transactions. Most family offices, smaller investors with a smaller capital are buying private investments, private equity investments, or company shares in unlisted companies without even knowing the details of that. And that clearly tells you that there is a FOMO, and and that applies across the board. How do you expect? Why do you think people bought HDB Financial before much higher than the listing price? Same thing is happening in Tata Capital and many more companies, right? Now they are all good companies, but does not mean that they're at any price you can buy, and you need to know a lot of things. So these kind of things do happen. So that letter basically tried to communicate investors in general that be careful, be cautious. Investing is not about making quick money, not about investing out of FOMO in the ongoing fads. You have to be very, very careful, because risk is far, far more important in investing than only looking at the returns. And in times of good times, this tends to get ignored.
Oh, absolutely. There's so much exuberance and FOMO within the unlisted IPO space. But Vikas, so what's looking like fair value right now? Something within the listed pool where you do have growth visibility and valuation comfort as well?
Absolutely. I mean, we are, Aisha, fully invested. So that tells you that, we are obviously seeing value in the market. We are obviously seeing the potential growth in the market. India investment story is not of a quarter story. It's of long-term investing story, medium to long-term. And anybody who tried to kind of, go in and out and look for value and expensiveness, they have only kind of lost money. Just think about it. Last 2 years, I've been hearing, markets are expensive, markets are expensive. And that's, if you ask me, and in fact, we wrote a letter to investors about 8-9 months ago that India is not expensive. So it's a wrong narrative which is created. In a long-term transformative phase of equities, of any economy, obviously valuations are going to go up. If they don't go up, it's something wrong with that. It's like saying same thing, the city is developed, but the real estate prices are going up and hence, you should move out of city. That's kind of bizarre argument, right? So same thing is, in my opinion, so to people who create this narrative, India is expensive, only are doing this service. It is about remaining invested, and it is the job of people like us who has to see what stocks, risk reward of remaining invested is not there, how to kind of churn the portfolio. And there will be pockets of, 3 months, 6 months. Like last 1 year, there has been many significant return at a market level. Of course, we have done as a fund very well, but at a significant market level, not much return. But that's bound to happen. But if you see 5 years, I'm sure it will be very different scene. So we don't think markets are expensive. We are finding value in banking system. We are finding value in CDMO pharma space. We are finding value in, reasonably good few consumer names. We are finding. So again, it is up to you to kind of look for what suits your philosophy. But we are fully invested, and we do think that India will generate good returns. In fact, I feel this year market will hit new high because there's so much pessimism and a little bit of good news, which could be any time around the corner. You will see, people jumping in for buying.
And to think of it, we are actually at an index level not too far away from that all-time peak in any case. But Vikas, since you are betting on a fresh high this year itself, what's going to lead the charge? Would it be financials once again, purely because of the weightage? Or do you actually see fundamentally financials also drive that move?
No, I think, of course, financials can lead that, and other sectors as well can. I mean, like all along, people have been negative on IT. IT, I think, can kind of do well from here. Manufacturing space, in pharma and all in my opinion, can continue to do well. We've been kind of fairly large overweight position in that. And within banking also, again, people think that, banking, according to me, can continue to do well. And we are reasonably overweight there as well. So I think you don't need a new sector leader to lead the market. I think the good part about this time's market is that we are having a very widespread, participation from the multiple sectors. And, even if one sector kind of loses steam for short term, other sector catches up. But in general, there's a very widespread participation of the sector. And that's what I think makes it very, very interesting.
Indeed, but Vikas, does it mean that the heavyweights might take a bit of a backseat and could be the broader markets and the other sectors that can fuel the rally? Because of late, the large caps have been holding up quite well, but even the broader markets is seen to be having a good time of late.
Absolutely. So again, look, see, when markets, sentiments turn bad, large caps tend to kind of hold better. And when the risk goes away and risk on happens, obviously mid and small cap tends to do better. That's a very normal cycle in any market which you have. And, the point I was making was that I think probably we will have risk on very soon, or sooner than later, because, a lot of pessimism is there. Everybody is talking negative. A lot of people are sitting on huge amount of cash. There are good shorts in the market. Now think about it. One news coming through about sorting out of this tariff issue, which is kind of looking towards overhang, and which I would assign a very high probability of getting it sorted out in next 3 to 6 months. Think about what can happen to market. As an equity share investor, interest rates coming down by 100 basis point, liquidity infusion, GST rate cut. These are the dream scenario for any equity investors. And today, why markets are ignoring this scenario? Because of this one overarching overhang, which everybody knows that's not such a big deal. It's a small 2% of total GDP, which probably we can recoup in 4 months' time. And I'm not saying it should not be done. What I'm trying to tell you that it's not like fatal for Indian economy. So and I'm also quite confident that this will get sorted out in one way or other very soon. And once that happens, you will see a reasonably good short covering, people sitting on cash buying, and you have to prepare for that scenario. I don't think market can go down another 10% unless some new development happens. So if the more upside is there than the downside, then you got to remain invested. And that's our thought, at least right now.
Because on the flip side, when we last interacted, you did say that you expect to see earnings upgrades trickling in from Q2 and going ahead. Now that Q1 earnings have been pretty decent, and the kind of commentary that we're hearing from the management on ground also across sectors indicates that earnings could only improve going ahead. Are you still retaining this timeline now, or also factoring in the entire tariff situation that's upon us?
Thank you for saying that, but like we've been always saying, that the whole narrative earnings slowdown was going on, corporate India is not growing, and according to us, it was kind of far from the truth. And we said that, that because last year in earnings got compromised because of the liquidity squeeze and, government spending slowing down, but both have got reversed. RBI governor infused the liquidity, interest rates came down. These things tend to have impact with their lag. Now, whether it is 2 quarter lag, 1 quarter lag, 3 quarter lag, I don't know. But generally, hence we were saying that this, ideally speaking, it should be Q2, Q3, it should start looking better. But Q1 also has not been bad either. So according to me, and if measures like GST and all can only boost that sentiment. So in my opinion, on an overall basis, if you look at 25-26 year basis, you will not have bad earnings. According to it, could be anywhere between 13-14%. Now, of course, some sectors will grow much better, some will grow slower. But net, the trajectory of earning is not going to be, disappointing according to us.
Interesting. Because the other thing I wanted to ask was, what about IT? I mean, is it just a bottom-up story because it's really not participated as a sector, or do you see fundamentally something changing for IT?
So I think, IT has been going through a bit of a consolidation, given the lot of technology transformation happening. Most IT companies have been investing. But if you look at the order wins of the IT company has been fairly decent. The execution has been kind of slow and bit delay. So I think, and stocks have corrected. They are good free cash flow generating stocks. So at large cap IT, you cannot expect significant returns. I mean, probably single digit or maybe early teens kind of returns you can expect on a sustainable basis. According to me, that's what potential is there. But within IT also, there are many companies, especially in our opinion, we maintain that for a very long time, that mid and small cap IT will do well because of their base effect, plus secondly, their ability to be agile and, be far more adaptive is far better. And hence, there are companies and also new segments are emerging, whether it is SaaS-oriented companies or product-oriented companies, where the non-linearity of the profitability kicks in. And and ER&D space is there, which is also fast growing. So you got to look at pockets which are fast growing. You got to look at pockets which are kind of a little bit different than the last cycle. So every cycle you will find new IT companies coming and becoming bigger. Think about it, 2009, post 2009 cycle, I think HCL Tech became, Mindtree came about, LTI, LTTS, they did not exist in that point. They were not sizable companies, but today they're all sizable companies. So every cycle brings new companies, scales up new companies based on. So I think we will see also from this cycle, new companies will scale up. Persistent was a tiny company 10 years ago. Today, look at what has happened. So I think every cycle brings new players, scalability, and that is the real opportunity to identify.
Till we get that name out of you on what you've identified now, we'll chat again soon and let you get back to work, Vikas. Thanks for your time.
Thank you. I'll be chatting.
Okay, let's move on. Sugar, that's the sweetest pocket in the market right now, given that India has now allowed production of ethanol from sugarcane juice, syrup, and all types of molasses without any restriction on volumes in 2025 to 26. Let me now welcome on board